Good morning to you, Jeff. What do we expect this earnings season?
Yeah, good morning. This will be an interesting earnings season, I think. And I mean, it's really going to be three things that people will be or should be focused on. One is, especially for the big guys, trading revenues. How good have the asset rallies really helped trading books versus a slowdown in volumes and activity in a lot of products? That's going to be a big wild card. And the other thing's going to be credit. And not so much how is credit this quarter, but what's the outlook? Are we still seeing delinquencies get better in the early stages, kind of across consumer buckets? Some of the recent credit card data would suggest that that trend has reversed, which may kind of dampen the outlook for credit a little bit. But I think those are the two big things. And then third, for anyone that has an asset management business, you know, how good will inflows versus appreciation be kind of for the revenues in those businesses?
So how much of a problem do you believe the consumer is going to begin to be again for banks when you're looking at that credit card segment of the business?
Yeah, I mean, specifically in credit cards, that's going to be a problem going forward just because of a lot of the accounting changes coming next year. I'm not envisioning a lot of very profitable credit card operations for the big banks. But consumer credit in general, I think the market is starting to expect not just stabilization, that maybe things will actually start to get better. It strikes me that might be a little premature for that. So we may get some unhappy messages along those fronts. But most people's attention is still focused on commercial real estate, where we're just starting to see some of the cracks come. That's probably going to be the credit story of 2010.
A key story on Bloomberg today is the reported $55 billion worth of mortgage collection contracts that four of the biggest banks may have to write down. How concerned are you about this segment of the equation?
Well, I mean, mortgage has been interesting in that it started in subprime, worked its way through. We've seen some problems in prime now, and you're actually seeing more of the problems in kind of the upper end of the housing market. I don't think we're through housing problems yet, but as far as things getting a lot worse than they have been in 2009, I don't really think that's going to be the case. So I'm kind of looking for a second half in 2010 where housing is not a tailwind, but it's not necessarily the rock around banks' necks that it's been.
How much longer will Citi and Bank of America stay on the government lifeline, do you think?
Well, there's two components to it. One is how long do they need to? I mean, when do the capital levels really get to a point where they don't need government intervention? And then secondarily, and probably more importantly, when will the government let them get off the dole? Because the one thing I don't think the government wants to do is let a large institution like a Citigroup or a B of A repay their TARP and really kind of be free and then have to come back in again. So,
do you have a timeline on either of those?
You know, I think for both of them, we're going to start seeing them make progress. You probably start seeing some money returned in 2010. And I think by the time we're kind of coming out of 2011, they'll be standalone entities. That's a very vague timeline, I realize. But it'll start in early 2010 probably, and it may well take them into 2011 to sell it all.
Well, perhaps we'll get more insight on that when we get some earnings from them. Thank you so much, Jeff, with your preview.